Let's bring in Siebert Financial CIO Mark Malek. And Mark, this is last week, and obviously what stands out here is a huge spike in healthcare. Like, seems like it sort of came out of nowhere. We're going to talk about this sort of transition, but to be clear, technology was the worst performer, but you still like technology. You're not saying you don't like it anymore.
Sure. I mean, tech is up and down, and that's part of. Look, we have to accept the cost for the expected great returns of the volatility.
Right.
This is part of the volatility. The long-term prognosis for the technology trade is still huge, and nothing comes even close to it.
Historically, July to December, in midterm years, folks, midterm years, nothing beats healthcare. Maybe people were getting a jump on that last week. Healthcare, industrials, materials. You happen to like, I think, healthcare, industrials, and financials a lot right now. Is it in part because of seasonality?
No, honestly, we've been sort of nosing around healthcare for quite some time. There are a lot of opportunities there that look cheap. We're not value buyers.
They've looked cheap though for a long time.
But exactly, and they've got. If you like them here, you'll like them even there. And we've been following some of that. But there are some great opportunities. There's some growth opportunities, specifically in pharma, which is what really drove that move last week. We've been looking at pharma, and there's some real no-brainer opportunities within pharma that we like. Industrials as well. We like to see some green on the screen every day.
Right.
That's how we follow the money. And there are industrial plays that play into the current environment as well.
Financials have been tricky, though. I mean, I feel like they've been tricky. Although stealthily they've kind of come on, I feel like they've been a disappointment, not just this year, but for the last few years. What's going to kind of get them in overdrive here?
Well, so when I talk about financials, I'm specifically looking at the bank, right?
Big banks.
The banks, right? Because the financials is a very broad sector. It's been held back a little bit by the poor performance in the private credit area, all those shakeups that happened earlier. But there's opportunity in the banks because of the interest rate environment that is pretty clear in which direction that's going at this point. At least more so one way than the other.
I got you. Okay, let's talk about what you like. A lot of folks come on with the Hormet these more recently. Lilly obviously feels like they've won the GLP war, but the thing is now the GLP itself, the use case for it just seems to be becoming more incredible every day, the things you read that maybe this could address.
Yeah, what's amazing, also you're correct, and what's even more interesting is now Lilly is changing the form factor, right? Because now they have the pills that you can take. So they're expanding the market because now they're pills, they don't require the refrigeration. You're talking about folks that maybe don't want to jab themselves that will now take the pills. So the case for Lilly was strong. It's stronger now. They just announced that pill, I think, in April, right? So that's really a big part of the catalyst that has us still focusing hard on Lilly as well.
I've been in GEV for a long time. I got such a great cost that I don't look at it, I don't care about it day to day for the most part. But folks who might have bought it recently might be somewhat frustrated. Maybe it's just come so far so fast that it needs to pull back periodically. And maybe your point is, when it does, maybe take advantage of it because you see a lot more upside.
Yeah, we do. And so again, as your last guest said, I don't want to you don't chase the tape on this thing. I mean, this makes a lot of sense. There's still a lot of upside. If you look at how much they own of the market and where they can grow, it's not just about AI, but AI is a big driver. And it doesn't look like it's going away for at least 12 to 18 months.
12, 18 months. They're talking about, really, we're talking maybe trillions when it's all said and done. And they've only got one or two competitors around the whole world for what they do and what every data center needs. It feels like a no-brainer. You hate to say that when it comes to markets, but it feels like I like the fact that you only went out 12 to 18 months because I think it's going to go even further than that.
It can, right? Yeah. But at this point, we have visibility out 12 to 18 months, and we're confident that the growth is still there. Things can obviously change, but in terms of the spending plan and in terms of the direction of everything right now, this stock is going to continue.
Before I let you go real quick, what's your greatest concern right now?
Honestly, my greatest concern was that report that you that just spoke about earlier today. The central banks are now getting a little bit worried about the hidden credit to build out all these data, off balance sheet.
Which is reflected in some of these private equity stocks. And obviously we see what's happening with software itself, which was easy money for private credit for a long time. Easy money.
But even the big names, if you look at Meta and such, they do this off-balance sheet, off-balance sheet financing. You got to watch that stuff very carefully because it has it can really extend. Any problems it can extend far into the...
And by its very nature, off-balance sheet means it's hard to watch it.
It's impossible to watch it.
All right, Mark, thanks a lot. All right, folks, talking about volatility in tech, what it means for you, and where the opportunities come because of that. Don't be afraid of it. You know, you'll be less afraid after you hear what Art Hogan has to say. He's a Wall Street legend, and he's got some fresh picks for you. We'll be right back.